In this video, we're going to talk about the two best ETFs to combine with SCHD to make a powerful 3 ETF portfolio that's based on different investing strategies. SCHD over the long term has shown some pretty nice returns over time, great dividend growth, and consistent dividends, making it a solid dividend ETF. But recently, many investors feel as though that has been getting dragged through the mud because of its lagging performance recently compared to previous years. Now, SCHD's strategy isn't about providing high returns, it's about dividends and stability as it leans towards value companies and it's focused on high-quality dividend payers that offer solid growth and dividends. Its selection criteria screens for companies that have more than 10 years of consecutive dividend payments, market caps above $500 million, an average daily trading volume of $2 million, and more filters that consider return on equity, 5-year dividend growth rate, and more, with a cap of 4% per stock and a 25% sector cap. These very specific filters are what allows SCHD to have a portfolio of solid dividend payers. But this detailed filtering also causes it to remove big winners or stocks that may experience explosive growth. And knowing how SCHD functions is key because this plays into the role that it has in these different 3 ETF portfolios that we'll be going through. First up, we have the high yield portfolio setup. These first 2 ETFs that we'll combine with SCHD function a bit differently, and they're known as covered call ETFs. And many high-yielding ETFs are able to pay out that high dividend income due to using what's called a covered call strategy. A covered call is an option strategy where an investor sells a call option on a stock that they already own, aiming to earn a premium. And the premium received from selling the call option is additional income for the investor. So these covered call ETFs will invest in a portfolio of stocks while also selling call options on the stocks in the portfolio. By doing this, the ETF is able to generate high dividend income for investors while also giving you exposure to the underlying stocks in the ETF's portfolio, which in the end provides you with much more dividend income than you'd get from traditional ETFs. Now, this first ETF is going to be qqqi, the NEOS Nasdaq 100 High Income ETF. qqqi strategy is to provide monthly income from investing in the Nasdaq 100 and using a data-driven call option strategy. And there's 2 parts to this. First is that qqqi buys and holds stocks in the Nasdaq 100, and second, it sells call options on the Nasdaq 100 index. So the income that you receive primarily comes from the option premiums along with the dividends of the stock holdings. This is how qqqi is able to offer such a high dividend yield of over 13%, which it pays out that income every single month. And moving over to the portfolio that makes up qqqi, this fund has 107 holdings. And if we take a look at the top 10 holdings and the sectors that make it up, you can see how it closely resembles that of the Nasdaq 100. You have names like Nvidia, Apple, Microsoft, Amazon, and others, while for its sectors, it's heavily exposed to technology, which is to be expected. Then we have communication along with consumer discretionary making up the majority here. For the returns, qqqi has only been around since January 2024, so not much history yet, but since then, it's had total returns of around 38%, including dividends. Now, the second ETF is a sibling to qqqi, and I say that because it's another NEOS fund, and that's SPyi, the NEOS S&P 500 High Income ETF. SPyi works just like qqqi, except it invests in the S&P 500 index. So again, with the 2 parts being that it holds stocks that are in the S&P 500, as well as it sells call options on the S&P 500 index. And keep in mind for SPyi and qqqi, they can sell index options on up to 100% of their portfolio. SPyi also has a nice dividend yield of 11.6%, which it pays out monthly. SPyi contains a total of 511 holdings, with top holdings in names like Nvidia, Microsoft, Broadcom, Tesla, and more. And the sectors it's mostly exposed to are technology, financials, communication, and consumer discretionary. Since this fund is based on the S&P 500 index, its portfolio is structured very similarly to it. For the performance, since SPyi was created roughly 3 years ago, it's had total returns including dividends of about 54%, so it's been doing solid. Now let's talk about this 3 ETF portfolio. And for this portfolio and the others in this video, these percentage allocations are just examples to help give you some direction. Now this portfolio will have an allocation of 40% for SPY, 30% for qqqi, and the last 30% for SCHD. SPY makes up the largest of the pie because of its similarities to an S&P 500 fund, so it's helping to lay a diversified base to the portfolio. Now remember, this is a cover call ETF that's based on the S&P 500, so it's not going to be exactly like VU. It's going to be more limited in its growth potential compared to a traditional S&P 500 ETF, and that same concept goes for qqqi with the NASDAQ 100. With that being said, SPY is a nicely diversified cover call ETF that comes with a nice double-digit dividend yield. Since qqqi is based on the NASDAQ 100, that extra growth potential from the underlying index and volatility offer even more potential for high dividend payouts, which it's managed to do very consistently so far. And these two together are a powerhouse for monthly dividend income. But just note, you do have about 50% overlap in weight between these two holdings, and that's mostly because those big names in their top 10 holdings. Now SCHD comes into play here, making up about a third of the portfolio to help balance out some of the growth lean in the portfolio, although it will still be the majority. SCHD also only has about 7% of overlap with SPY and about 5% with qqqi, so it fits nicely in between. And SCHD also brings in a history of strong dividend growth and a great dividend yield for a non-cover call ETF. Alright, so since qqqi was created in January 2024 and SPY in August 2022, we don't have a 10-year window of this portfolio, but since qqqi's creation, it's had total returns of just under 38%, and for the last 3 years, so a bit after when SPY was created, it's had total returns of 67%, and SCHD in that same time frame, almost 33%. And if we look how this portfolio did since qqqi was created in January 2024, it provided annualized returns of 14.4%, including dividends, and the dividend yield this portfolio provided was roughly around 10% between the three funds. This portfolio is leaning much more on large cap stocks in general, so I don't want to say that it's extremely diversified, but it could very well be if another high yield fund that was less growth focused was swapped out for qqqi. Either way, I think this is definitely a high yield focused fund with the use of SCHD to add a touch of some more balance to the portfolio. This next portfolio is focused on a combination of dividends and capital appreciation. And the portfolio is going to have a traditional ETF along with the cover call ETF. This traditional dividend ETF is going to be VYM, the Vanguard High Dividend Yield ETF. This fund tracks the FTSE High Dividend Yield Index, which includes companies that offer nice stability and high dividend yields. It comes with a dividend yield of 2.4%, which it pays out each quarter. Getting to the portfolio of VYM, this ETF has 580 holdings in total, with top holdings in names like Broadcom, JP Morgan Chase, ExxonMobil, Johnson & Johnson, and more. Along with the top sectors it's exposed to are financials, technology, healthcare, consumer defensive, and industrials. So this ETF has a nice spread of exposure to a variety of different sectors, and it's not top heavy, given that the top 10 holdings don't make up a huge portion of the portfolio. For the returns, VYM has had 5-year annualized returns of about 15% and 10-year annual returns of nearly 12%. And this next fund is a cover call ETF, and it's going to be qdvo, the Amplify CWP Growth and Income ETF. This is an actively managed fund that first aims to provide capital appreciation and secondarily high monthly income. It does this by investing primarily in growth-oriented large cap stocks, and it's able to pay that high income from option premiums and dividends. And qdvo seeks to provide income of around 0 to 2% from the dividends of its holdings and 4 to 6% from option premiums, plus the potential for capital appreciation. For those dividends, qdvo has a dividend yield of 9.2%, which is paid out to you monthly. As for the stocks in qdvo, this fund has a total of 57 holdings, with companies in its top holdings like Nvidia, Microsoft, Google, Meta, AMD, and others. Sliding to the sectors, it's mostly exposed to technology, communication, and consumer discretionary. qdvo has had some very nice performance since its creation a little over a year ago. It's had total returns, including dividends, of over 30%, and it had returns of nearly 18% from just stock price appreciation alone. So it's been doing really great. Alright, so for this 3 ETF portfolio, the allocation that I chose was 35% for VYM, 35% for qdvo, and 30% for SCHD, so it's split almost evenly. I had to be sure that VYM made a larger percentage of the portfolio because of the diversification that it offers, with over 500 dividend-paying companies and its variety of sector exposure, and it's serving as the core to this fund. qdvo is up next, and that's for its amazing returns and future potential returns, with its focus being on capital appreciation, and is providing some exposure to some very strong growth names, along with a very strong dividend yield. Next, with SCHD, it's helping to balance out the portfolio from the more aggressive stocks that qdvo holds by leaning more into the value that you find in VYM. Aside from the additional dividend benefits, while it may not hold many stocks, it still adds to diversifying the portfolio. The most overlap is found between VYM and SCHD, with an overlap weight of about 20%, and that's from the bigger names in SCHD like Home Depot, AbbVie, Chevron, and a couple others, which most of these holdings have 1% or less overlap. Because qdvo has only been around since August 2024, it's quite new, so I can't show the last 10 years performance of this complete portfolio. But here's the performance of both SCHD and VYM over the last 10 years, both providing almost 200% in returns. As for qdvo, since it was created in August 2024, it's had returns of over 32% in roughly 13 months. And you can see how well these returns are when you compare it to an S&P 500 fund like VU or a growth fund like qqqi, which qdvo has outperformed both of them. Depending on how the funds are adjusted, this can be a much more growth-leaning portfolio with not only higher potential returns, but also this combination can provide some pretty nice dividend income. This next portfolio I'd call the Diversified Dividends Fund. The first ETF in this portfolio is going to be a heavy hitter when it comes to the dividend growth, and that's dgro, the iShares Core Dividend Growth ETF. This fund tracks the Morningstar U.S. Dividend Growth Index, which is made up of stocks that have a history of consistently growing their dividends every year across a variety of industries. This fund comes with a dividend yield of 2%, which isn't too bad, and that's paid out to you quarterly. And dgro holds around 405 holdings in total, with top holdings in companies such as Apple, Johnson & Johnson, ExxonMobil, AbbVie, Procter & Gamble, along with some others. And for the sectors that make up dgro, it's going to be financials up top, technology, and healthcare for the top 3. So it comes with some nice diversification, and it doesn't hold too much weight in any of its top holdings. For the returns, dgro won't let you down, with 5-year annualized returns of just under 14% and 13.5% annual returns over the past 10 years, delivering solid results. And this next fund is going to be slightly different, and that's VYMI, the Vanguard International High Dividend Yield ETF. This fund tracks the FTSE All-World X US High Dividend Yield Index, which contains international stocks that are expected to have above-average dividend yields. The purpose of this fund is for its international exposure to further add diversification to a portfolio while still being a fund that offers a nice dividend yield, which this fund has a dividend yield of around 3.9% that's paid out each quarter. VYMI has a total of around 1,511 holdings, with its top holdings being in Nestle, HSBC, Shell, Toyota, and more. For the sectors, it's financials up top, then you have energy, industrials, and a handful of others that are pretty balanced out, but it's definitely pretty heavily tilted in financials compared to the rest. And as for the regions that this fund is exposed to, it's mostly Europe, the Pacific, and emerging markets. For the performance, VYMI has had 5-year annual returns a bit over 15% and annual returns of 10% since it was created short of 10 years ago. Now, the purpose of this portfolio is to essentially have 3 funds that provide nice yields, as well as this combination provides diversification across both US and international stocks with a value tilt. The allocation for this portfolio is 50% for dgro, 30% for SCHD, and the remaining 20% for vymi. With dgro being the largest percentage, it's acting as the core holding in this portfolio due to its diversification of over 400 dividend growth-oriented companies. While SCHD is a solid dividend fund and it has an even better yield than dgro, it only has around 103 holdings, so it's a bit limited in terms of diversification. Also, the nice thing about this combo is that aside from dgro also holding primarily value companies, it also has exposure to some growth companies as well. And together, they have only around 18% of overlap in weight, which comes from names like AbbVie, Home Depot, Coca-Cola, Pepsi, and a few others. And to further diversify this portfolio, we have the addition of vymi for international dividend-paying stocks. Since this fund is strictly international, there's no overlap of holdings between dgro and SCHD. This allows the portfolio to have exposure to stocks globally, mainly through large-cap companies, along with some mid-cap and then a very small amount of small-cap. If we jump to the returns of this portfolio, over the last 10 years, this portfolio would have provided annual returns of about 11.8%. Great results for a portfolio that's diversified quite well. And the dividend yield for this portfolio would be nearly 3%. I think the combo of dgro and SCHD work very well together, and vymi is the icing on top for some international exposure. Next up, we have the growth-focused portfolio. This first ETF in this portfolio is going to be a broad market ETF, and that's VU, the Vanguard S&P 500 ETF. This fund aims to track the performance of the S&P 500, which contains the 500 largest companies in the US. And the S&P 500 is made up of large cap stocks, and this index represents around 80% of the total US stock market cap, so these companies play a big role in the US stock market. VU has a dividend yield of just 1.1%, which is paid out quarterly, so don't expect big dividends from this fund due to the variety of stocks that it has. This fund holds a total of about 504 holdings, with its top holdings in familiar names like Nvidia, Microsoft, Amazon, Berkshire Hathaway, and others. For its sectors, we have tech coming up on top, financials, consumer discretionary, and communication. S&P 500 and broad market ETFs can provide a solid foundation to a portfolio along with some great diversification. The S&P 500 has really been moving these past few years, with VU having 5-year annualized returns of a little over 16% and 10-year returns of around 15%. Some amazing results that this index has been providing. The next piece to this portfolio to add to those returns is SCHG, the Charles Schwab US Large Cap Growth ETF. This fund tracks the performance of the Dow Jones US Large Cap Growth Total Stock Market Index, so it invests in large cap growth companies. Since it's a growth fund, when it comes to the dividends, it's going to be a little bit trash, with a yield of only 0.36% that's paid out quarterly. For a growth fund, SCHD has a decent amount of stocks with a total of around 197 holdings. The top holdings for this fund are in those big names like Nvidia, Microsoft, the rest of the Magnificent Seven, Broadcom, and Eli Lilly. For the sectors, it's going to lean into those same names, so that's why you see tech making up nearly half of this portfolio, with communication and consumer discretionary following up behind. The top 10 stocks in this ETF make up 60% of the portfolio, so they are key drivers to this fund. Like any growth fund, performance is going to be the best part. SCHD has had annual returns of over 17% in the last 5 years and about 18.5% in the last 10 years. Growth has been providing some incredible returns as of recent years. This 3 ETF portfolio is quite different from the others, since it leans a bit away from the dividends and focuses more on growth and appreciation. The allocations for this portfolio that I picked was 60% for VU, 25% for SCHG, and the remaining 15% for SCHD. The purpose of having VU in this portfolio is that it lays the foundation of this portfolio with the diversification of holdings that it has. The S&P 500 gives you exposure to a range of sectors and stocks, and it has a blend of both value and growth companies. SCHG, on the other hand, being a growth fund, it adds to the exposure of those growth stocks that VU has, increasing your potential returns by much more. But keep in mind that SCHG and VU have 54% overlap by weight, and VU has 64% of the stocks that SCHG holds. So basically, you'll be getting double the exposure to those top 10 holdings like Nvidia, Microsoft, and others that you find in VU, adding more risk and volatility to the portfolio. The last part of this portfolio is SCHD, and it's a supporting fund here for its dividend benefits and the value-focused stocks that it holds. This adds to help balance by adding to the portfolio's exposure to value stocks, given the addition of more growth from SCHG. If we take a look at the returns of this portfolio, this combination and allocation percentage over the last 10 years would have provided some nice annual returns of over 15%. So it can be a portfolio with some really great potential returns. The fact that it's very tilted towards growth, some investors may view this as limited in diversification for a 3 fund, which I could agree with. But ultimately, the ETFs or portfolios that would be best for you would depend on your specific investor profile. And if SCHD still doesn't do it for you, then there are some other dividend ETFs that you can look into, which I talk about in this video here. Or if you're interested in dividend ETFs with double-digit yields, then watch this video here. Don't forget to like and subscribe to the channel. Keep on investing, and I'll catch you on the next one.